Hello everyone, good evening. Good evening, Navya. Okay, so in yesterday's class, we have successfully completed revising the important topics from section C. So today we are going to revise section D. So section D is about cost management. Okay, yes. So first, we have to understand what is meant by this cost management. Okay. So given for any manufacturing unit, okay, so they will have incurred and they will incur a lot of costs. And we know that in order to become more and more efficient, we will have to reduce our non-value adding costs. We should go on reducing our costs and becoming more and more efficient. That will be the aim of any given organization. So in order to become more efficient, it is very important for us to understand what are the costs we are going to incur in an organization, which are most important and which are not. Is there any way for reducing the costs and becoming more and more efficient? For this analysis, we need an extensive knowledge of what are the costs that we are going to face in the organization and how to deal with them. So we speak about the entire cost management techniques in section D. Okay. So here, the main topics that we will be covering is cost classifications. What are the types of costs? Then the second important topic is about costing systems. So the classified costs, how we are going to analyze them, how we are going to organize them in the costing systems, and what are the methods of costing. Then the third important topic is about joint products and byproducts. Later, we study about the overhead allocation. So why differently for overhead allocation? Why not for direct material and direct labor? Why overhead is so distinct from both of them? And how do we allocate it? Okay. Then we also focus on ABC, activity-based costing. Later, we will have to study about absorption costing and variable costing. Then shared services. That is, what are the services we are offering for other fellow departments in the organization and how do we estimate their costs. Okay. Then comes operations. So here we study about the various operations that we do, including JIT, Lean ERP, and SCM. So then comes quality management and value chain. Okay. So we'll start with the cost classifications. Yes. So the major distinction that we will have to understand is between product costs and period costs. Okay. So these product costs, how do you guys define product costs in simple words? What is meant by product costs? It is so simple. What is meant by product costs? The money spent on making product and which is available to sell. Good. So cost incurred on production of the product. Very good. Okay. So product cost is nothing but the cost that we have spent on the product and that is becoming the part of the product itself. So what are these costs? So these are also known as our inventoriable costs. Okay. So there are some costs without which you can't produce the product itself. So such costs you will be adding into the product. So these are the costs without which product itself cannot be made. Okay. So first up, we have direct material or the raw material with which we produce the finished products. Then comes direct labor who convert the raw material into finished goods. Then comes manufacturing overhead. Okay. If we take automobile manufacturers as an example, their direct material will be the tires of the automobile, the rear glass, okay, and the engine. All of them can be direct material. Okay, direct labor are the people who are joining or assembling all these raw materials into the finished product, that is an automobile. Then what will be the manufacturing overhead? So they will use some small quantity of raw materials, we could say. So let us say, for example, they might use these screws or the nuts, or they can also use the glue to attach the glass and all. So all of these are also required in the production process, but you can't exactly count how many screws were used in manufacturing a automobile. That micromanagement nobody does. Okay, so those small quantities which are very difficult to be counted, so they will be added into manufacturing overhead. Okay, indirect materials used in the production process. So in our product cost, we'll be having direct material, direct labor, and manufacturing overhead, which is both variable and fixed. Okay, so what are the key formulas that we need to know in product costs? First up, we have the prime cost, which is nothing but direct material plus direct labor. Then conversion cost. So what is this conversion cost? So in order to convert the raw material into the finished products, what are the costs that we are going to incur? That is known as conversion cost. So in order to convert direct material into finished goods, you are needing the help of direct labor and manufacturing overheads. Okay, so conversion cost will be direct labor plus manufacturing overhead. So now these product costs, you guys remember measuring our ending inventory under the current assets in our balance sheet, right? So how do you get that inventory value? It is nothing but the product costs of the units that are remaining in the ending inventory. You will just add up the product costs of all the units that are remaining in ending inventory together. That is itself our ending inventory value. Okay. Then all these product costs, which are up to the extent of units that you have still not sold, that is remaining in your ending inventory. Okay, so these ending inventory units, you will be selling it to the customers. Once you sell it to the customers, this ending inventory value will be converted into cost of goods sold. Got it? Same ending inventory value, it will become the cost of goods sold on our income statement after we sell our ending inventories. So this is how we treat our product costs. So next up, we have the period costs. Okay, so what are these period costs? These are also the costs that are incurred in the act of manufacturing itself. But these are not so important for us. These are just supporting us for manufacturing the products, but they are not becoming the part of the final product. Okay, so what are these period costs in the sense? Costs for activities other than production. Let us say, for example, in the manufacturing unit, you are requiring electricity, okay, and drinking water. So all these are essential requirements for us, but they are not becoming the part of the final product. Okay, so we don't add the period costs into the product. So how do we treat this period costs? As soon as we incur them, we will be expensing it. For example, if you get the electricity bill for your manufacturing unit, you will pay it off. You will expense it immediately and you will pay it off. You will not include that cost in your final product of manufacturing the automobiles. Okay. Now these period costs, they will be expensed immediately as incurred. So for example, the selling and administrative expenses, electricity bills, building rent, all of them. And it cannot be traced directly to the product. That is the main thing. You can't trace them directly to the product. And these are not so much essential for production process. Okay, these just support us for producing the products. Then, under the period costs, we have variable non-manufacturing costs and fixed non-manufacturing costs. Okay, so as usual, both variable and fixed, we are going to expense them immediately. Okay. So next up, so this US gap and absorption costing we'll study later in the next slides. Yeah. So the next classification is based on with the fixed, variable and mixed costs. Okay. So we know about them. So here we should understand the behavior of fixed costs and variable costs. Mixed cost is the combination of fixed and variable cost. So fixed costs are those costs, no matter how much is our activity level, we will just incur this cost. Complete amount needs to be paid. For example, rent. Okay, if we have rented a room, whether I am staying in the room or not, I will have to pay the rent for it. Similarly, fixed costs means once you have committed for these costs, you will have to pay it. Got it? So here, what is the behavior of fixed costs? Okay, guys, can you tell me what is the behavior of fixed costs in terms of per unit and total? What is the fixed cost behavior? Okay, so fixed cost behavior is such that fixed cost in total remains constant. Okay, and fixed cost per unit that you're going to allocate for the products, that goes on changing. Okay, yeah. The more the products that you are producing, the fixed cost per unit will go on reducing. Okay, because the total is remaining constant. If you are producing more and more units, then what happens? You are dividing the fixed cost for more number of units. So your per unit fixed cost will go on reducing as you increase your production. Okay, and the best examples will be rent and salaries. Okay, next up we have the variable cost. Variable cost per unit it remains constant and in total it goes on changing. Let us say for example, I am manufacturing product A. Okay, and here I require raw materials for each of the product and which is worth of 10 rupees. That is variable cost per unit, 10 rupees. If I produce 10,000 units, my cost will be 100,000. Okay, suppose I produce 5,000 units, my total cost will be 50,000. Like this. Per unit will remain the same and in total cost will go on varying. It goes on changing. That is the behavior of variable cost. Next up, we have the combination of fixed and variable cost, which is our mixed cost. Okay. So here, under the mixed cost as well, we have two distinctions. So it is called as semi-fixed cost and semi-variable cost. So now, what is the semi-fixed cost in the sense? The fixed cost will remain fixed only up to the relevant range. Okay, let me give you an example of the electricity bills. So from 0 to 200 units, according to the Karnataka government specifications as of now, from 0 to 200 units, electricity bill for the owner will be free. They need not pay anything. Okay. Then from 200 units of electricity to 400 units, assume you will have to pay $200. That is fixed. If your electricity bill is anywhere in between 200 and 400, you will be paying $200. Okay, per unit. Then what happens? Suppose you are using somewhere around 400 to 600 units. Now what happens? Until your 400 units, you will be paying $200 per unit of electricity usage. For any unit that is greater than 400 units that you are using, you will have to pay $400. Okay. So how is this working? Until 400 units, that is from 200 to 400 units, you will be paying $200. Suppose you are using 450 units of electricity. For up to 400 units, that is from 200 to 400 units, you will be paying $200. For additional 50 units that you are using, you will be paying $400 per unit for the last 50 units that you used. This is how semi-fixed costs work. Okay, so when you plot this data on a graph, you will easily see the step-ups of this particular cost. Up to 200 units, you will be on the scale of zero pay. Next, again, when you increase yourself into 400 units, you will be on the pay of $200. Again, when you increase your usage limit, you will reach up to 400. So when you plot that, you will exactly see a step movement. Okay, that is why we also name it as step cost. Then we have semi-variable cost. So what happens with the semi-variable cost? So the best example is the people who work in the sales department. Okay, so sales department personnel, they will be having fixed salary. And if they reach the target, if they reach sales number more than the given target, for that additional sales that they did, they will be getting commission. Okay, so now basic salary, let us assume $20,000 per month. Next, what happens? I have given them a limit of 100 sales. I'm sorry. Okay, I have given them a limit of 100 sales, but that person reached 120 sales. For that 20 sales extra what they have done, I'll give them commission. Okay, so commission will be $200 per extra sale. So 200 into 20 sales, additional sales. So you'll be paying them $40,000 additionally. Okay, so here up to 100 sales that they are making, basic salary is fixed, 20,000. Then for any sales additionally they are making, they will be getting $200 extra. Okay, so this is called as semi-variable cost. So both semi-fixed and semi-variable costs are called as the mixed cost. Okay. So next up, we have the topic of direct costs and the indirect costs. So what are these direct costs and indirect costs? Okay, so in simple definition, we call them as direct costs are those costs which can be traced directly into the specific object. Indirect costs are those costs for which it will be very difficult for you to trace them into the final object. Okay, so we already took an example for this, automobile manufacturers. Okay, so the direct materials in automobile manufacturing sector, for example, we can take it as the tires of the automobile and the rear glass that they are using, and then the engine that is being used. So all this we can call them as direct materials. And these costs of 4 tires and 1 rear glass that is used in the front and 2 mirrors and also the engine, you can directly trace it for the automobile, the car that you are manufacturing. Okay, and in the same way, you will be using many small useful tools such as the screws, the nuts and the glue. You can't allocate saying that I've used 1 lakh screws for this car. Nobody does that because it's not possible to count. Okay, so that is why those small quantities of tools that we are using, that will be added up and they will be accumulated as indirect costs. We can't trace it individually for a product because of their minute nature. So those costs will be there in indirect costs. In direct costs, there will be some specific costs that you can directly trace into the products. Okay. So manufacturing overhead, that is why we call it as an indirect cost. And one thing that you guys need to remember is in our manufacturing overhead, you can have 3 types. Okay. Indirect material. The example I gave you, the screws and the glue that you're using, that comes under indirect material. Okay, there can be indirect labor as well in your production process. And these indirect costs, they are together clubbed as manufacturing overhead. Okay, and how do we allocate this manufacturing overhead? It will be based on the cost pools. You will just add up all the costs together, whatever your manufacturing overhead is. And based on this cost pool and its cost driver, we will be allocating it. Okay, that is why manufacturing overhead allocation itself is a separate concept. We'll study that in detail. Now, for now, we have to understand what is this cost pool and cost driver. Okay. So cost pool is just the group of indirect costs that uses the same allocation base. Okay. Say for example, all your machine related costs. Machine means we are using this in manufacturing activities. Okay. So these machine costs, you will allocate it based on the machine hours. Okay. So cost pool is nothing but club all your indirect costs together. That will be your cost pool. So then what is this cost driver? So cost driver is any sort of activity that causes the costs to be incurred. Okay, let me give you an example. In order to manufacture a product, you will have to set your plant and equipment. You will have to set your machineries. For that, you will be incurring some setup costs. Okay, you will require some laborers for setting up the manufacturing equipments for manufacturing process. Okay, that involves cost. So now, what is the cost driver? The setting up of the plant and machinery. So that is your cost driver. As soon as you conducted this activity, immediately you got step-up costs. So that is a cost driver. Okay. So now for allocating this setup costs, you will be using the number of setups that was required. Based on number of setups, we will be allocating them. Okay. So now there are some other costs also which we need to remember. So first up, we have explicit costs. So what are these explicit costs? These are nothing but the costs that we enter in our income statement. Any cost that you are paying in cash, those costs are known as explicit costs. It can be your rent, salary, or bills and payments that you're doing in cash. That is called as your explicit costs. Okay. And there are some other expenses also included in your income statement that are non-cash. For example, depreciation. That is called as the implicit cost. The only segregation criteria is cash outflows. If there are cash outflows for that expense, it is explicit. Okay. And it is also called as accounting costs. Suppose there are no cash transactions, that becomes implicit cost. Okay. So now, implicit cost in our income statement, one small example will be a depreciation. Then we have something called as opportunity costs. Okay. These opportunity costs are also best examples for implicit cost. So these opportunity costs, what is meant by this opportunity cost? It is the cost of foregoing the next best alternative. Okay. So as human beings, we will be able to choose only one decision at a time. We can't perform two tasks at the same time. I can't be present in two places at the same time. Okay. So that is why in every decision that we make in our life, there will be an opportunity cost. There will be many decisions, among them which is giving me the best profit, I will be choosing that. So as I choose only one decision, as I choose only one thing, I'm not choosing the rest of the other options I have. So the opportunity cost of choosing the best thing is you are foregoing all the other opportunities you have. Okay. For simple example, let us say after completing your graduation, anybody for that matter, they'll be having two choices, either to continue with their higher education or to join a job immediately. Okay. Assume that that student is funding their studies by themselves. Okay. Now, after completing their graduation, they have zero income level and zero expense. They are neutral. Now, if they will have two choices, either for choosing higher education or to go for a job. If they go for a job, let us say for a salary of 30,000, now their net position will be 30,000. Their net worth per month will be 30,000. Suppose this person who doesn't have any income sources is now choosing to opt for the higher education. Okay. So what will be the costs involved in this higher education? They will have to take a bank loan. As I told you, this student is funding their studies by themselves. They will have to take an educational loan. Again, that's a negative balance for them. Let us say, for example, they have taken an education loan of 50,000, for example. Okay. Now you know what is their net position according to opportunity cost. They have taken a bank loan for 50,000, already in a negative balance of 50,000. And again, they have foregone this opportunity of going for a job for 30,000. Okay, so now their total loss is not this 50,000 plus the opportunity cost that they left off. They didn't choose for going to the job. That additional 30,000 also will be added up. Now their total opportunity cost will be for choosing their masters. It will be $80,000. Okay, so this is the concept of opportunity cost. In any decision that we make, opportunity cost is always there. So that is why we should choose the best one, which gives us the best benefit. So now in our example, what could have been the benefit for this person for taking this opportunity cost of 80,000? After completing their education, they might get a higher package. Let us say somewhere up to 50,000 to 80,000 they might get. That will be their benefit. Okay. Then comes sunk cost. So this sunk cost is nothing but the cost that is already incurred. And whenever you see sunk costs in your question, the thing that must come to your mind is they are never relevant for decision making. Why? Because you have already incurred that cost. Suppose you are making a decision to purchase a mobile phone, okay, and you have already purchased your mobile phone in the past week, in the recent week, you have already purchased. Now you can't, there is no use in deciding which would have been the best model of phone to select from. There's no use because you already purchased it. That is why sunk costs are never used in decision making. Next up, we have the committed costs. And guys, because that you are able to see in the last line, the last four sets of costs, if you get a question regarding them, the only way to identify them is through the keywords. You should notice the keywords properly and then you have to choose between these options. Because when you read the MCQ question, and if all these four options are given, you'll find that all of them might suit this scenario. The only way is you should find out the keyword to choose the best option. Okay. Now, first up, we have this committed costs. So what are these committed costs? That means you have already entered into a contract. You have already decided that you have to incur this cost. Okay. Suddenly in middle of the contract or suddenly in middle of the time period, you can't say you are not going to pay for it. Let us say, for example, you have so you have signed a rental agreement with your house owner that you will stay in that house for, let us say, 12 months. Take this as an example. Okay. For 12 months, you have signed a contract that you will be staying in that house by paying them rent. That's a commitment you have made for 1 year. Okay. So soon after 3 months, you can't go and say them that I will not be paying you rent anymore. I don't want to continue this agreement or contract. You can't say that. So that will be like foregoing your contract and that leads to other legal consequences. So what are these committed costs? Once we have already decided to incur those costs, until the contract ends or until you paid the costs completely, you will have to pay it. Let us say, for example, you have purchased a car on EMI. Okay. And after you have purchased, that is done. That's a commitment. Every month you have to pay EMI until you complete it. So suddenly in the middle, you can't come out. Okay. If you do so, then you will have to give back your purchased asset to the bank. Bank will seize it. Okay. That is committed costs. Now, some of the committed costs example will be infrastructure costs, which are required to maintain the readiness to operate the business. Okay. Or for example, loan on the fixed assets that we get. And most probably your fixed costs, they will come under the committed costs. Once you have used the services, you will have to pay the fixed costs. Then comes discretionary costs. Okay. So what are these discretionary costs? It will be occurring according to the desire, according to the decision of the management. Okay. So if managers choose that in this year, I will be incurring this cost, they can. And it will be completely in their decision and in which month they will have to incur this cost. Okay. So best examples for discretionary cost will be advertising and repair and maintenance. You can time it in which year you will have to provide for the advertisement so that you will pay for it. You can time these expenses. That is why they are discretionary. Okay. Next up, we have engineered costs. So what are these engineered costs? So how to identify them is they will have a cause and effect relationship between the inputs and the outputs. Very well defined cause and effect relationship will be present. So if you find any costs which have a proper cause and effect relationship, then that will be your engineered cost. For example, cost of goods sold and the sales commission. Okay, the more the sales units you have, the greater will be sales commission you need to pay. There is a cause and effect relationship. Such costs will be engineered costs. Okay, then comes marginal cost. We know this concept of marginal analysis. So it is analyzing what cost or revenue I will be incurring for producing or selling one additional unit. That is our marginal analysis. Marginal cost is nothing but the additional costs that you have incurred for producing one additional unit, one more unit. Okay. So marginal cost analysis is very much important for our short-run decision making. Okay. How do you identify committed cost? It is like a contract. Once you enter into it, until you finish that payment or finish that contract, you can't come out of it. That is committed cost. Then comes discretionary cost. You can time these expenses according to organization's requirement, according to management's decision. Then engineered cost, you will have to identify cause and effect relationship between inputs and outputs. If it is there, then that's an engineered cost. Then comes marginal cost, the cost incurred for producing one additional unit. Okay, so these are the major types of costs that we need to know. Yes, so these being the cost classifications, what are the costing systems and methods that we are using? Okay, so now as a management accountant, I have identified all the costs that an organization is incurring. Now I should see how can I measure these costs? Okay, how can I measure these costs into our final products? How to allocate them? Okay, so first step, I will check what are the cost measurements I can do for my final products. Then how do we allocate these costs for different types of projects that we have? Then what are the other costing methods that I have? These are the three decisions that I'm going to make. Okay. So now let us look into the cost measurement systems. So what is this cost measurement systems? I'll tell you. So here, assume a manufacturing firm. Okay. So any given manufacturing firm, they should be very quick in determining the selling price of their products. You know why? Because before they sell their products, at least 2 to 3 months prior to selling their products, they will have to advertise the products, because only then customers will come to know that such a product is there in the market and its utility are so and I can buy it. Customers need to decide, right? That is why advertisements and marketing has to go on. So for advertising the product, you should give an idea for the customer what will be the cost of purchasing that product. Okay, now this cost measurement methods will help us to find out the price at which I can sell my product. So this pricing activity, it has to take place as quickly as possible for manufacturing firms. Okay, they can't delay in pricing their products. One necessity is this advertising and marketing activities. Other necessity is their competitors will be very quick in pricing their products. If you delay any time in pricing your products, you will lose there. Okay, that is why pricing has to be very quick. As soon as possible, we need to price. So for pricing a product, you should know what is the cost of production, right? So now there is a need for measuring our cost into final products. How are we going to measure them? There are three methods: standard costing, normal costing, and actual costing. Okay, so standard costing, when you will use this, you already know, you definitely know what will be the standard cost for producing a product. Let us say, for example, Apple iPhone. Okay, so Apple company will know what will be the cost for manufacturing one iPhone. Standard cost they will know. At that point of time, when you are 100% sure about the cost that you are going to incur, you will be using standard costing for measuring your product. So what happens in standard costing? Okay. Yeah, there will be the distinction between standard costing, normal costing, and actual costing. First, let us understand what are these costing systems, and then we will come to know their differences. In normal costing, what happens is that normal costing and actual costing, you can use it only for customized products because you don't know what type of an order your customer is giving you. Let us say, for example, the Rolls Royce. It's highly customizable. Okay, so you will not come to know the cost of that car, Rolls Royce car, until you customize it for your customers. According to their needs, you need to customize it for them. Until you complete your manufacturing process, until you completely produce or manufacture the car, you will not come to know what is the cost you are incurring, because these products, it will be customized according to the customer's needs. So until they are completed, you will not come to know what might be the cost. In such cases, you will be using normal costing and actual cost. Okay. Now, let us look into the distinctions. In standard costing, when can we use this? When we know for sure what is the cost we are going to incur. Okay. At that point of time, it's very easy for direct material, direct labor, and manufacturing overhead. Whatever your standard rate is, you will just take it and multiply it with the standard quantity. That is how we find out material, labor, and overheads in standard costing. Very easy. Okay. Then what happens? In our normal costing, as I told you, it's very customizable. Until you produce it completely, you will not complete. One more example which we can take is, if you go to a designer and if you give them specifications to design your dress. Okay. So if you might have experienced this, they'll tell you the advance payments. They'll tell you, pay me 5,000 now. Rest of the things after manufacturing it or after completing your dress material, I'll tell you. Okay, because they will not come to know according to your customization what might be the cost. At that point of time, they have to wait until they get the actual rate. So they'll be using actual rate for direct material because they will have to check what is the quality of direct material required for customized product, and they should add it. Then direct labor, how many hours of labor was required for producing that customized product? They should know, right? So now for material and labor, actual rates will be used. When it comes to manufacturing overhead, so again, there is two cases in normal costing and actual costing. Some cases you will know what is the manufacturing overhead predetermined rate, you will be knowing. So this manufacturing overhead, what is there? It's just a supportive material, small quantities or supportive tools. If you know the cost exactly, you can use predetermined rate. And even that, if the company or the designer doesn't know, then they can go for actual rate for manufacturing overheads also. Okay. Now, in what sort of situation we will be using this? So, standard costing is used for both job order costing and process costing. Then, normal costing will be used mainly for job order costing. Actual costing will be used for only job order costing. So, what are this job order and process costing? We'll come to know in the next slide, which is about the cost accumulation methods. Okay. Now, variance calculation. Yeah. So, this is simple. To calculate the variance, what are the two requirements you guys need? Can you tell me in a simple equation, how do you calculate variances? All of you. What is the formula to calculate variance? Perfect. So it is the actual data minus the budgeted data. That is how we calculate the variances. Okay. So before entering into variance calculation under the three costing systems, first know whether there are standards and actuals available, because only then you can calculate variance. Without standard or without actual, you can't calculate variance at all. Okay. Now, when it comes to standard costing, standards are available for all DM, DL, and MOH. It's available. And actual data, anyhow, we will be getting. So, variance calculation is possible under standard costing. Okay. So, we can calculate all the variances, DM, DL, MOH, all the manufacturing input variances you can calculate in standard costing because you know both standard and actuals. Now, when it comes to normal costing, so look at this. Direct material variance, direct labor variance, and manufacturing overhead variance. Can we calculate direct material variance? In normal costing, can we calculate direct material variance? Yes or no? Think carefully and tell me. Is it possible to calculate direct material variance in normal costing? Look at the equation again. You need both actual and standard or budgeted. Okay. And with respect to this equation, find out, is it possible to calculate variance, that is direct material variance in normal costing? Is it possible? So it's very simple, guys. So in normal costing, you don't know the standards at all because it's a customized order for which you are not able to determine what could be the standard cost. Okay. So at that point of time, you don't have the standards at all. For direct material also, for pricing, you will have to wait until you get actual rate. So standards itself is not there for normal costing direct material. So when standards is not there, you will have to assume your actual data itself as your standard. Okay. Now what happens? Actuals will be there. Yeah. It will be like subtracting your actual data from your actual data. So there will be no direct material variance itself in normal costing. You understood the reason? Because standards are not there. Look at this. For standard costing, you have perfect standards for DM, DL, manufacturing overhead. But what about normal costing? Standards are not there. So how can we calculate variance? Actual data should be there, standard data should be there. Only then we can calculate. Okay. Now tell me, can we calculate variance for direct labor under both normal costing and actual costing? Yes. How is it possible, Nikhil? Okay, guys. It's a very simple concept. You guys know, right? How to calculate variance. Variance is nothing but actual minus budgeted. Both the things you should know for calculating variance. Okay. So look at this normal costing and actual costing. What is happening? Actual data itself is there for your direct material and direct labor. You don't know the standards at all. Without knowing the standards, how can you calculate variance? Even if you calculate, it will be zero. It will be like actual data minus actual data, which leads to zero. So, fix it in your mind. For normal costing and actual costing, direct material and direct labor variance cannot be calculated because there are no standards at all. Now, when it comes to manufacturing overhead, for normal costing, you can calculate. So look at this. You are using predetermined rate. This concept you should be very clear about. For normal costing, what is happening? You are using standard rate. Okay. How do we first allocate the overheads? It will be like standard rate into standard quantity allowed for actual output. Okay. So now what happens in normal costing? Look at this. Standard rate we are using, but again for actual number of hours. Okay. But still our manufacturing overhead variance calculation is possible. For normal costing, you can calculate because standard rate, you know, right? Standard rate, you will be comparing it with the actual rate of manufacturing overhead. We can calculate it for normal costing. But for your actual costing, it is not at all possible. Because for all the three, DM, DL and manufacturing overhead, you are using actual rate itself. Standards are not available. So, there are no variance calculations that is possible in actual costing. Okay. And in standard costing, all the variances are possible because for all the three, you know the standards. And here, only overhead variances are possible. To say it to you in detail, efficiency variance, again, you can't calculate. Why? Decode it properly. For efficiency variance, what do you need? Standard hours minus actual hours minus standard hours into standard rate. This is how you calculate. So in efficiency variance again, you're using, look at this, actual hours itself you're using. Here also standard hours you don't have. So efficiency variance also you will not get here. Only variance that is possible in normal costing is variable overhead spending and fixed overhead variances. Only these three are possible to be calculated in normal costing. Okay, so now tell me, all of you understood this topic of standard costing, normal costing and actual costing? Any doubts or confusions? Everybody's clear? About remaining students? Keep interacting, guys. Okay, so now let us move on to our next topic, which is about cost accumulation systems. Okay, so in cost accumulation systems, based on the type of order you're getting from your customers, so you will be choosing between job order costing or the process costing. Okay, so when do we choose? What is this job order or process costing? So job order costing is used when units are distinct and separately identifiable. When you are getting customizable orders from your customers, you'll be choosing job order costing. Okay. Suppose you are getting identical orders or mass production orders from your customers, you will be using process costing. Okay. So now let us understand in detail about the job order costing. So here, as we discussed already, we can take the example of dress designing, interior designers. The interior design from house to house, it will vary. Then custom furniture, the construction, all of them. This construction of building or factories, it is highly customizable again. So all of these customizable orders that will be coming under job order costing. They are not at all identical. They are very separate and distinctly identifiable. Okay. So now for job order costing, what happens? If it is a customizable order, until you completely manufacture or until you complete that production, you will not come to know what is the rate you are going to get. The example is if you call an interior designer and if you say them the specifications about the interior design you want in your house, what they will tell is exact amount. It's difficult to say. You can pay us the advance. Okay. And later after we complete the work, we will give you the final bill. This is what they will say. Because they don't know exactly what will be the actual cost. Okay. So in that case, what we will be using? We will be choosing either in between actual costing or the normal costing. Okay. Standard costing you can, but only in extreme cases when you know exactly what will be your cost. There will be some very much experienced interior designers as well and dress designers as well who have that experience to say the standard cost for their products. If they are able to, they can use standard costing. Suppose they are not able to find out, then they will have to switch. They will have to choose between actual costing or the normal costing. Okay, and we know how we calculate the actual costing, normal costing, and standard costing. For standard costing, no need to worry. Everything is standard. For actual costing, again, no need to worry. Everything will be actuals. And for normal costing, DM and DL will be actual. Overhead will be for your standards. Okay. Now, what is the benefits and limitations of job order costing? So the benefits are gross profit per job you will calculate. That means gross profit that you're incurring per customer you can calculate, so that you will get to know which customer is more profitable to you and you can get more orders from that customer. You can prefer them more. Then cost control per employee. So now assume a dress designers, a group of dress designers. You have a firm where you have 10 dress designers. Okay. And they are getting an order from each of your customers. Now, based on the designer, you can decide which designer is using more cost, which designer is earning more profits, which designer is into more cost controls. You can analyze that properly and give them proper guidance. Okay. Then comes limitations. So here in job order costing, there will be massive data entry. Every penny you are spending for that product, you will have to list it down, because only then you can arrive at actual cost, right? So massive data entry will be there. And if any entry is missed, again, price will fluctuate. Then again, your input errors risk. Every data when you have to input, as human beings, committing errors can occur normally. Okay, that leads to input errors risk. Okay, then. Next up, we have process costing. Here, it is used when units are identical or similar. Okay, and here you will be accumulating the costs by department or by process. So here, the major distinction is here you are accumulating by job. That means per customer you will be getting a job, and per customer you will be billing. Per customer you will accumulate the costs. Okay, but in process costing, what happens? We'll understand with a simple example. Assume you have to, it's your birthday and you need 100 pieces of chocolate cakes from a bakery. Okay, so as soon as you go and place an order, they'll tell you exact bill. So it will cost somewhere around. So you're ordering 100 chocolate cakes, cut pieces, and now it will have to cost somewhere around, let us say 50. Okay, they'll tell you it is 50 per cake, and in total you will have to pay 5,000. They'll not say, so wait until tomorrow, we will tell you. No, because that's a regularly recurring process. They'll come to know what will be the cost. Okay, so for that type of orders, you will be choosing process costing. When you readily determine your standard cost, at that time you can choose process costing. So again, when you look into the baking of chocolate cakes, there will be different departments for it. First department for mixing the ingredients, let's say for example, the second department for the fermentation of the cake, the third department for selling them to the customers, like this. According to process, they will divide into departments. Okay. Now, here you can accumulate the costs according to the departments or according to the process that is involved. So this process costing, you can use it for any type of identical or similar orders. Okay. Now, in process costing, you readily know the standards. Now, what you'll do? You will choose standard costing. Aram se we can use the standard costing here, because for everything we know the standards. Okay. So now, for the costs, you will be using direct material plus direct labor and manufacturing overhead. And here, you will know both standard cost and what is the actual cost that you are going to incur. It will be known to you. So here, the three cost sources will be, first one will be incurred in the period. That means in the period in which production is taking place. Then transferred transferred in from the prior department. Okay, let us assume there is a process. There are three processes in manufacturing chocolate cakes. Okay, and you are in process 2. For this process, they'll get the added cost from the process 1. Mixing the ingredient cost will be sent forward to next department, process 2. And this process 2, again, they will be incurring some cost which they will forward into next department, and finally in that way they will be able to cost that product. Okay, so now one thing you will have to remember is about the equivalent units of production. So what is this equivalent units of production in the sense? Yeah, so let us take for example the same 100 chocolate cakes order that we got. 50 chocolate cakes are ready and 50 chocolate cakes are ready and 10 units, that is 10 cakes, are 30% completed. Okay, so when a customer asks you what is the progress of the preparation, you can't say them 50 cakes are done, 10 cakes are 30% completed. You can't say. So as a bakery owner, what you will say? You'll round it off. So saying that 10 cakes are 30% done, in the sense approximately 3 cakes are completed. So you'll say them 53 cakes are done as of now. That is how we will report. Okay, that is called as equivalent units of production. So if they are in work in process stage, you will have to convert them into equivalent units. Approximately, they will turn into how many number of finished goods. You'll have to convert them, and then you should consider that equivalent units that are being completed. Okay, and here in process costing, you will be using standard costing. And in job order costing, you can use standard costing, normal costing, or actual costing according to the convenience. Okay. So next up, spoilage. So in process costing, again the spoilage issue will be there. So what is the spoilage? So let us take, for example, if we are baking 100 chocolate cakes, let us say due to some overboiling or over mixing, or something that way, 10 cakes have gone wasted. That is spoilage. Okay, in any given manufacturing, there will be some spoilage that takes place because not everybody will be 100% perfect in the manufacturing processes. Now, if these spoilage occurs, how do we treat it? So spoilage is nothing but the defective units removed from the production, and they already have some accumulated costs. So now how do we account for this? There are two types of spoilages, normal spoilage and abnormal spoilage. Normal spoilage is the normal course of spoilage that happens. Best example will be the oil refineries. Okay, whenever oil is being transported, it's normal that 3 to 5% of oil will be wasted in the course of transportation. You can't avoid it. So the spoilage that you can't avoid, that is normal spoilage. Abnormal spoilage is we could have planned properly without proper planning or due to uncertain situations that came, more spoilage took place than normal spoilage. That will be our abnormal spoilage, which you can avoid, but it still took place due to various reasons. Okay. Now, how do we treat this normal spoilage? We will just allocate it into good units. Why? Because this is out of our control. Always it will take place. Nobody can avoid it. That is why you will add it into the part of your good units. You will add it into the cost of good units and consider that as cost of goods sold. So remember, normal loss, it will be added into cost of goods sold of the good products. How do you treat abnormal spoilage? So it is greater than the planned amount. More than the limit of normal spoilage, we have lost it. At that time, it is to be expensed as abnormal loss in our income statement. Okay. So for example, bakery is producing 100 units. 10 units somewhere getting spoiled is normal. Suppose, this cost of losing your 10 units or spoilage of your 10 units, you can add it to the cost spread of 90 good units that is there. Okay. Anything beyond 10 units, if you're losing, at that time, it will be added as abnormal loss in your income statement. That is how we treat it. So next up, there is a flow for cost of goods manufactured. So cost of goods manufactured, we all know already how we calculate this. So it is beginning raw material inventory plus purchases. That will be equal to raw material available. So minus your ending raw material will give you raw material used in the production, plus direct labor plus manufacturing overhead minus beginning work in process, plus beginning work in process and minus ending work in process gives you cost of goods manufactured. Okay, in simple terms, your manufacturing costs plus beginning work in process minus ending work in process gives you cost of goods manufactured. As simple as that. Okay, so next up, yes. So now we are discussing about the concept joint products and byproducts. Okay. So first up, what is meant by this joint product? Let us understand. So there are some products which share some common production process until a specific limit. You can take an example of crude oil. Okay. This crude oil, until you process it unto certain stage, let us say, crude oil needs to be initially processed until its certain stage. Only then it gets split up into petroleum products, petrol, diesel, kerosene. Only then you will be able to distinguish or segregate this crude oil into other products. So this common production process which all these joint products are sharing. So that is called as the joint cost. Okay. And one more simple example which we can take is milk. So milk, they will be processing it to certain extent. Okay. Only when raw milk is processed unto certain limit, only then you will be able to convert it into curd, ghee, cheese, butter. So in order to convert them into these products, initial production process need to be taking place. So that is called as joint production process. Okay. So the cost that you are going to incur will be joint cost. And the products that are resulting from this joint production process will be joint products. Okay. So now there is a stage where your raw material will be splitting into joint products. So that point is known as your split off point. Okay. So the cost, any cost that you are incurring before the split off point. What is the split off point? The split off point is where milk is turning into curd, ghee, cheese and butter. It's the point where crude oil turns into petroleum, diesel, kerosene and etc. Okay. So that point where you are distinctly identifying your joint products. Until that point, whatever cost you are incurring is your joint cost. Until split off, whatever cost we got is joint cost. From split off and afterwards, costs after split off, they are called as separable costs. Or you can call them as further processing costs. To be very specific, they will be called as further processing costs. Okay. Now, what are the four methods that are available for calculating this joint cost? So now we came to know that, let us take this example of milk turning into curd, ghee, cheese and butter. Okay. So these are the joint products that have been occurred. And this joint cost, we need to allocate it in between these 4 units, right? On what basis we are going to allocate the joint cost for these 4 products? That is what we study in joint product costing. So there are 4 methods: relative sales value at split off, estimated NRV, physical measure, and constant gross profit method. Okay, so now in the relative sales value at split off, so split off point we came to know where our raw material is turning into distinct products. So that is the split off point. So if you are able to sell all your joint products at the split off point, then only we will be using relative sales value at split off method. Okay, now how do we allocate the joint costs? It is simple. It will be based on the sales value at split off value as the percentage of total sales revenue. Okay, so it's very simple. If you are able to sell curd, ghee, cheese and butter, what is the total sales revenue that you will be getting? Okay, and you will find out individual sales revenue percentage for the total sales revenue. Then you will be allocating the joint cost based on that. Okay. And this method is the best one because at the split off point where joint products formed, at that point itself, you are able to allocate the joint costs. Okay. Now, this method is preferred when all products have market prices at split off. Suppose there is a product, let us say, for example, petroleum. We'll take it as an example. Petroleum is a joint product. Okay. At split off, it is not of any use for me. I need to convert it into pure petroleum for selling it for helicopters or selling it for to be loaded for the helicopters or the airplanes. They need pure form of petroleum. Okay. At that point of time, petroleum is not useful for me. I can't sell it. I need to further process it. So sales value at split off I will not get for the petroleum. I need to convert it into pure petroleum. Okay. At that point of time where sales value at split off is not there, first method can't be used. So this method is easy. Yeah, it's easy and it's intuitive. It's intuitive because just that the split off we are able to divide this joint cost among the products. And it is based on revenue generating ability. Yes, based on sales value capacity itself, we are allocating the cost. So it's correct. Based on the capacity of that product, we are allocating the cost for it. So what are the limitations? Prices must exist for all the products at split off. If not, you can't use relative sales value at split off point. Next up, we have estimated net realizable value method. So what happens here? Suppose, so this is a default method. To be frank, when sales value at split off is not there, you have no other choice. You will have to choose estimated NRV method. Suppose sales value at split off is also there and net realizable value is also there for all your products. At that time, you will be using relative sales value at split off itself. Even though your NRV, net realizable value, or the final sales value is available after further processing cost, even if that is available, if you have the sales value at split off, you will still have to choose first method, not the second method. Okay, so I'll give you one hint in your examination. When they give you sales value at split off and both sales value at split off and NRV, both of NRV in the sense final sales value, both the things they have given to you. Okay, and they have not mentioned with which method you have to use. But at that time, you will have to choose the first method because that's the rule. When you know sales value at split off, first method itself you should use, even though you can further process and sell those products. Okay, keep this in mind. Suppose they are asking you in the question to use the estimated NRV method itself, then even though you have sales value at split off, use NRV. By default, we will be choosing sales value at split off. Okay. Now, what is this NRV? After further processing the products, at what price we will be able to sell? Based on that sales revenue, you will be estimating the cost here. So here, NRV, net realizable value, is nothing but final sales value minus separable costs. Okay. And it is used only when split off prices don't exist for some products. Okay. Then the limitations are, it's a complex method when you compare with the first method and it uses a single set of prices. Okay. So next up we have the physical measure or average cost method. So what happens in the physical measure method? So based on the physical quantities such as the weight, the volume, the number of units, based on that you will be allocating your joint cost. So it's a quantitative unit method itself. And here what happens is, so usually in the actual market scenarios, what we observe is the units that have less weight, they can be sold for more prices. The units that have larger weight, they can be sold for less prices comparatively. I'll give you an example. When it comes to metals, okay, gold weighs very less. Okay, so that lightweight gold itself, you can sell it for lakhs together. So the price at which you can sell gold as a metal is more. Even though its weight is very less, it is valuing more. On the other hand, take an example of iron. Okay, so iron will have a lot of weight when compared to gold, but its sales price, when you compare with the gold, it will be very less. Okay. Now, when you choose this physical measure method, what you will do? You will allocate maximum cost for iron, which we are able to sell for very less price when compared to gold. Okay. For gold, what we are doing? We are allocating very less cost, even though we are able to sell gold for a lot higher price when compared to iron. Okay. So what is happening is we are giving more burden for the products that are not able to generate sales revenue. And we are liberating, we are giving only less cost for products which are already having plenty of adequate market prices. Okay. So now that is the biggest limitation of physical measure. We will allocate cost based on weight, but actually the less weight products are sold for more price. More weighted products will be sold for less price. That's the biggest limitation. Okay. Then comes constant gross profit method. So what happens here? So in this method, what we do is, first we will calculate what is our gross profit from this entire joint production process. That is first calculated. Suppose your joint cost is 1 lakh and your revenue that you are getting from all the joint products, let us take it as 2 lakhs. Okay. So now your cost is 1 lakh. The profit that you are able, the revenue that you are able to generate is 2 lakhs. So flat 50% gross profit you are generating. So that is found out first. Okay. Now what do we do? This gross profit, it will be allocated. This gross profit percentage, we came to know 50% gross profit percentage. What will I do? I'll take the sales price of all the 3 joint products. Okay. And I will calculate the gross profit from each of them. I'll subtract the gross profit from selling price. And if there are any separable costs, even those costs I will subtract from the selling price. Remaining value will be used for contributing to the joint cost. Okay. So here what do? We'll take this final sales value and we found out the flat 50% gross profit percentage. Flat 50% sales revenue I'll subtract. Then if there are any separable costs, again I'll subtract from that. Remaining value you will use it for joint cost allocation. This is the same way we will do for all the products. Okay. And one more important thing is, this is the only method that results in negative allocation. I'll tell you how it is possible. Look at this mathematically. Look at this sentence mathematically now. Okay. Suppose your sales revenue is 100 rupees. Sales value is 100 rupees. Okay. And gross profit is 50 rupees. You'll subtract 50 rupees from sales value. Remaining is 50 rupees. Okay. So suppose your separable cost itself is 60 rupees. Remaining value is 50. Your separable cost is 60. Now what happens to your joint cost allocation? How much do you get, guys? Calculate and tell me. Your final sales value is 100. Your gross profit is 50. Your separable cost is 60. What value do you get for joint cost allocation? Will it be in positive or negative? -10. Perfect. So this is how negative allocation is possible in constant gross profit method. Okay, very rare in case, but it do happens. Okay. So now what is meant by this negative allocation? So what does that indicate? It is an indication to the company that it shouldn't give a lot of stress of joint cost for that product because already it is not having good gross profit generation. Okay. Now what do? They'll just allocate this joint cost for other products. They'll not trouble this product. In this indication -10, it is indicating that 10 rupees more we will have to give it for this product. Okay. In simple words, just understand negative allocation is possible. In this negative allocation, you will come to know that that particular product, whichever got negative allocation, is having very less gross profit in the market and you don't burden that with joint cost. You will allocate the joint cost for other products. Okay. Everybody got an idea of what are the methods of joint costs? Joint cost allocations. Yeah. we'll look into the practical examples. So now, first up, we have relative sales value at split off. So here what happens? Each product selling price divided by the total selling price. For an assumption, example, milk is getting turned into curd, ghee and butter, and each of them have a sales value at split off. Now, your joint cost is $100,000 and your total selling price, 3,000 plus 10,000 plus 15,000, it is $18,000. Okay, we will find out the percentage for allocation. 3,000 divided by 18,000, which is 16.7%. So, you will multiply this rate, which you find out for each of the products. For ghee, it will be 10,000 divided by 18,000. Butter, it will be 5,000 divided by 18,000. Okay. Once you find out the rates, you will multiply them with the joint cost and you will allocate this cost for the respective products. So this is our relative sales value at split off method. Then next up, we have estimated NRV method. Okay. Now, assume you are converting. What is this NRV? When do we get this NRV? When we further process our joint products. Only then we will be getting our final sales value. So now, final sales value minus our further processing costs we will have to calculate. So now what happens? Assume curd is further processed into hung curd. And here we are getting the final sales value as 3,500. And separable cost or the further processing cost, it is $500. Okay. Then the next NRV, the NRV will be 3,500 minus 500, which is 3,000. This is how we calculate NRV. Final sales value minus further processing cost, you will get NRV. Then for ghee, you are using it into baking sweets. And your final sales value is $15,000 minus 5,000, you get an NRV of $10,000. Butter, you are turning it into premium butter. So $6,000 is your final sales value minus separable cost of 1,000. You can take it as further processing cost. So it will be $5,000. Okay. Your total NRV is $18,000. 3,000 plus 5,000 plus 5,000. 3,000 plus 10,000 plus 5,000. Again, it will add up to 18,000. So same percentage allocation as method 1. Actually, it need not be same total NRV. Here, it's just a coincidence. Okay. Then, it is used only when split off prices don't exist for all the products, one or more products. Okay. And the limitations, as we discussed already, slightly complex and requires sequence of further processing info. Okay. So next up, we'll look into physical measure and average cost. Okay. Physical measure, quantitative unit, you will be allocating based on physical quantity, average cost based on the physical units. Okay. Now assume there are 3 products, mild, original and ES. Okay. So here, $500, for $500 you are selling your mild product, and for $100 you are selling your original product, and $50 you are consuming it for ES. Okay. Now what happens? The product that has the maximum sales revenue is mild. Okay. And based on the physical measure, if you find out that mild is having the least weight, then even though it has a maximum sales revenue, you will be allocating very less joint cost for this. Remember the gold and iron example which we took. Okay. Same case will happen for all the products in physical measure. Maximum joint cost load will be on the products that are not able to generate sufficient sales revenue. Okay. Minimum joint cost will be allocated for those products which are earning a lot of market revenue for the products, Okay. So that is what is our limitation. May result in costs to be greater than market value for some products. Physical measures not always are comparable. Okay. Next up, we have the constant gross profit method. So it's very simple. First, we will find out gross profit percentage. Total gross profit divided by total sales value. Then Individual gross profit for each of the products we will calculate. Final sales value of the product. Final sales value we will get after further processing cost. Okay. Multiplied with overall gross profit percentage. Then overall gross profit percentage multiplied with sales value. You will be getting the gross profit that you need to subtract. Now, how do you calculate joint cost? It will be final sales value minus individual gross profit minus separable costs. Okay. Now, why is this method unique? Because we discussed already, negative allocation is there. Mathematically, it's possible, and in some cases, it do occurs. Okay. Now, selling price minus profit minus your separable cost or further processing cost, it gives you a negative amount. Okay. And here, it assumes all products have same cost to sales ratio. That's the limitation. So why are we assuming this? Gross profit percentage, suppose it is 50%. Okay. For all the three products, assume mild, original and ES. For all of them, you assume gross profit percentage is 50% itself. It may not be the case. For mild, it can be 30%. For original, it can be 50%. For ES, it can be 10%. But by default, we'll take 50% for all the products. That's a limitation again. Okay. Now, next up, we will have to discuss about the byproduct costing. So what is this byproduct? In our further production, in our process of producing these joint products, okay, there will be some products that will naturally result in. You don't have an intention for producing those products, but naturally they are resulting. Okay. One example which I can give is in a wood furnitures manufacturing firm, the sawdust that they get from the wood. Okay, that's a byproduct. And this sawdust, they can sell it as a raw material for some other industries for a very minimal amount. Okay, so that is how byproducts are calculated and sold. These byproducts are low value products that are naturally resulting. You don't have an intention to produce them, but out of your joint production process, they are naturally resulting. And that products, you will be selling it for a very minimal amount for other manufacturing concerns, whoever needs it. So now, they might ask you a question. At what sales price can you sell your byproducts? Okay. And they will give you all the joint costs and transportation costs. At that time, what you will have to think is, byproducts anyhow, they are getting produced without our intention. Naturally, they are coming out from the joint production process. So, literally, there are no cost that is involved in producing this byproduct because we didn't manufacture them. They naturally result. So, there is no cost of production for this byproduct. Your only cost for this byproduct, if you incur, will be transportation costs, which will be incurred for transporting these goods into your customers, whosoever buys your byproducts. Okay. So, when you want to sell byproducts, any given price, if it is greater than your transportation cost, you can sell it. Okay. So, when you want to sell byproducts, remember transportation cost or any other additional cost, if it is there, more than that cost, if any given price, you can sell it. And when byproducts are resulting, how do we need to account for them? So there are two methods, production method and the sales method. So this, according to this production method, what happens is, you will use this production method only when byproduct costs are little bit significant in your firm. If it is costing somewhere around 1000 or 1500, according to the size of the manufacturing concern. If you think it is significant, only then you will be using production method. Okay. So in production method, what do we do? Whatever the revenue that we get from the byproduct after selling it, we will use that for reducing our joint cost. Okay. Suppose the revenue you got from byproduct is 1000 and your joint production cost is 10,000. Further on, you will reduce that joint cost by 1000. You got a revenue from byproducts, right? You will use that for reducing joint cost and you will further value your joint cost at $9,000 and $9,000 you will allocate for main products. Okay. So that is how we account it, production method. Then what happens in sales method? In sales method, You'll use sales method when byproducts are very insignificant in your firm. Okay, you're getting only $10 for that byproduct, which is not so significant for you. At that time, you'll use sales method. So what is the sales method? You'll completely ignore the cost of byproducts. You'll not recognize them in your accounts at all because of their immaterial amount. Then what happens with this byproduct is you will sell it for your customers, whosoever purchases that. And the revenue that we get from selling this byproduct, it will be added in income statement. You will mention it as income from byproduct, and you will mention that. That is how we account for byproduct in sales method. So when it comes to which method to use, both the methods are accepted. If the byproduct's value is very significant, you will be using production method. If it is very insignificant, you will be using sales method. Okay. So this is how we account for joint products and byproducts. Okay, guys. So I think you all have got an understanding of joint products and byproduct costing. Any doubts? Okay, then. So we'll take a break for some time. Yeah, we'll take a break until 5:45 and we'll start the class. Okay, guys. Take a break and come back at 5:45. Hello students, are you all back? Can we continue the session? Okay. So next up, it is of our overhead allocation and the activity-based costing. Okay. So now we will look into what is this overhead? Why do we need to allocate it separately? And how are we accounting for it? Okay. Yes. So first up, we know these overhead costs are nothing but our indirect costs. Indirect costs are those which you cannot directly trace into specific units because of their minute nature. Okay. So what happens? We will just add them all these together into cost pools and we will allocate it. Allocation in the sense you will add the costs together and based on a certain percentage, you will be allocating it for the final products. Okay, because we can't trace them directly into final products, we will allocate it. So now overheads include the indirect materials such as lubricants or small tools and indirect labor such as plant superintendent, janitor, or the quality control personnel. So all these people will be intended to maintain the good working condition of plant and equipment. It is supporting activity, but not a very much essential activity. It is not what is becoming the part of the product. That is why it is indirect. Then general manufacturing overhead such as factory rent, electricity, equipment depreciation, all of them come under overhead. Okay. Now, how do we allocate this overhead? So it will be based on two systems, either traditional or activity-based costing. Okay. So now in traditional overhead allocation, we will allocate these overheads either based on our direct labor hours or direct machine hours or based on number of units produced. These are the methods which we use in traditional overhead allocation. Okay. So here we allocate the manufacturing overhead based on single volume based measure, direct labor hours or machine hours or material cost or units of production or weight, like this. So that is a traditional system. Okay. And here in traditional system, we have again the company wide rates or the departmental method. So what are this company wide rates and departmental method? So company wide rate means it is similar to finding out our standard cost. Okay. So across the company, we will find out one standard manufacturing overhead rate that we need to apply. So manufacturing overhead standards, as we all know, it will be determined according to our direct labor hours usage or machine hours usage or units. Okay, so based on this, we will allocate or find out the standard manufacturing overhead per direct labor hour or per machine hour. So that is our company-wide rate. So wherever overhead is to be allocated, we will use that rate itself and we will allocate it. Okay. And this company-wide rate, it is one rate for all departments. It's common for everybody. So how do we calculate the predetermined overhead rate? It will be budgeted overhead divided by budgeted activity level. As simple as that. Then next up, we have the departmental method. Okay. So when do we use this departmental method? So there are some departments which are labor intensive. Okay. There can be some other departments which are using only machines. At this point of time, for departments which are mainly based on labor hours, you should use labor hours for allocation. For departments which are mostly using machine hours, you have to use machine hours for overhead allocation. So in departmental method, which department is using what type of hours, labor hours or machine hours or units, you will allocate it based on maximum usage of that department. There are some departments for which you will allocate in DLH, direct labor hours. Some other departments you can allocate them in machine hours as well. So that distinction is possible in departmental method. So applied overhead, how do we calculate? It will be predetermined rate multiplied with actual activity. And variance, we know this. Actual overhead minus applied overhead. You will be calculating the overhead variance also in the traditional overhead allocation. So next up, we will have the concept of the overhead allocation based on activity-based costing. Okay, we'll discuss that in the next slide. There are two methods itself, that is traditional overhead allocation system and the activity-based system. So one system we have completed, traditional overhead allocation we completed. One more is ABC. We'll discuss that later. Before that, there is a concept of this under-applied and over-applied overhead. So what is this concept? Okay, so overheads mainly consist of the expenses such as factory rent, electricity, equipment depreciation, small tools, lubricants, and all of that. Okay, the cost of which you will come to know only after the month end or only after the quarter end, sometimes only after year end. Okay, until that point of time, organizations usually don't wait until they get actual overhead values, because I told you earlier how important it is to price our products as quickly as possible. Due to that reason, you can't say your customers, please wait until I give you bill. I'll give you the bill once I pay my electricity bills. You can't say that. Please wait for one more month. After paying our electricity bill, I'll give you your bill because I want to add electricity bill. That's my overhead. I should add to the price and I have to price you. We can't say that to our customers. Okay. But what to do? We will get our bills only at the month end. So that is why we will estimate our overheads. Okay. What could be maximum possible overhead that I am going to incur? I will estimate it. This estimated overhead, I will be allocating to the products and I will sell it. I'll price the products and I will sell to the customers. Okay. So now our estimated overhead, whichever we estimated, and the actual overhead that we incur, there can be differences among them. There are three possibilities. You could have estimated exactly the same actual overhead, or your expectation might be less than the actual overhead you incurred, or your expected overhead can be more than your actual overhead incurred. Okay. So already we have entered in our accounts these estimated overheads. And if we find out from the actual overheads that there is some variations in our expectation and the actual overhead that incurred, we can't leave our accounts as it is. When you notice there is a difference between your estimated overhead and actual overhead, you will have to correct your accounting records. They have to reflect the correct balances. So that is why we need to adjust them. At that time comes the concept of under-applied versus over-applied overhead. Okay. So here what happens is, when your estimated overhead is less than the actual overhead that we incurred, when estimated overhead is less than actual overhead, that is called as under-applied, because you have estimated the overhead less than what it needs to be. That is under-application of overhead into your products. Okay. So we know about this application of overhead. That means you are allocating overhead rate into your final products. Okay. Under-applied in the sense, it occurs when your estimated overhead is less than actual overhead. So you have allocated less overhead into your final products than what needs to be allocated. Okay. That is under-application of overhead. Now, over-application of overhead means you have estimated more overhead than what you actually incurred. Estimation is more than actuals. Now what happened? We have allocated more overhead into our final products than what needs to be allocated. 1 minute, guys. Okay. So that is over-applied overhead. When you estimate more than actual, that is over-applied. We need to adjust our accounts now. We know that in under-applied overhead, what happened? We have applied overhead less than what is our actual overhead. Now what happened? Our cost of goods sold was understated. I have applied overhead less than what I incurred actually. COGS became understated. I need to increase its value. So what is the entry that we are going to pass? It will be debit cost of goods sold account. Cost of goods sold is an expense account. If you need to increase it, you will have to debit it. Okay. Then you will be crediting your manufacturing overhead control account. I told you that initially in the beginning of the period, we will estimate our overhead, right? So that estimation will be in our manufacturing overhead control account. Okay. So this COGS account you will be enhancing with this balance. Suppose your applied overhead is greater than the actual overhead that incurred. That means we have over applied the overhead into finished goods. That means our cost of goods sold is overstated. Now what to do? We have to reduce cost of goods sold. We have over applied overhead than our actual overhead. We need to reduce it. At that time, you will be crediting your cost of goods sold account and debiting your manufacturing overhead control account. Okay. And one more thing you need to remember is, if you have underapplied the overhead, that means COGS balance is less. You have taken less COGS balance than what needs to be. You need to increase it. That means your net profit will be reducing. Now, what happens if it is over applied? Okay. Now tell me what happens to your net income if your overhead is over applied. Will it increase or decrease? Okay, guys, find out and type in your answers. I'll be back in 2 minutes. Okay. Okay, guys. Nobody got to know? Try it out once again. So I told you that we have over applied the overhead. So what happens when we over apply the overhead? Our estimated overhead is greater than actual overhead that we got. That means, suppose your electricity bill is 10,000, actually what you got, but you estimated it to be 12,000. This 12,000 you have allocated for your products. It is more, right? Now you will have to reduce it from your cost of goods sold. Now, what will be your impact on net income? What is the impact on net income? Okay, tell me this. If it is over applied overhead, what happens to cost of goods sold? You will have to perfect. Very good. Yes. So now what happens? It is over applied overhead. you will have to reduce your cost of goods sold. For a 10,000 rupees expense, you have allocated 12,000 for COGS. 2,000 you have to reduce it. Okay. When you reduce cost of goods sold, obviously your net income will increase. As simple as that. Okay. Yeah. So you will have to read this twice or thrice. Then you will understand the logic. It's very simple. Okay. For under applied overhead, COGS will be understated. You will have to increase it. And what happens to net income? Net income reduces. If it is over applied, what happens to COGS? It is overstated. You will have to reduce your cost of goods sold. Then your net income will increase. Yes. And there are two more things that we have to remember here. Immaterial amount and material amount. Okay. So again, the same concept. If it is an immaterial amount, very negligible amount, let us say somewhere around $100 or $50, no need of taking this effort of adjusting the accounts. Simply, as it is immaterial amount, you can adjust directly into cost of goods sold. Suppose it's a very material amount, 10,000, 15,000 or 20,000, then we will have to divide it. We will have to prorate it in between work in process, finished goods and cost of goods sold. Okay. So then there can be an expectation in the MCQs. Okay. They will ask you a question. If you prorate your under applied or over applied overhead balances in between your work in process, finished goods or cost of goods sold, what will be the net impact? There will be no net impact because you are increasing or decreasing the amounts among all the three levels of inventories and cost of goods sold. Okay. So what happens to your net impact? Net impact will be nil because one thing you guys remember, whenever it is inventory and cost of goods sold, both of them are inversely related to each other. If you reduce an amount from COGS, you will add it back to inventory. If you are reducing from inventory, you will add it back to COGS. That is all what happens. Okay. So then if it is a material amount and when you prorate, okay, there will be no final changes that are going to happen in your balance sheet or in your financial statements. Balances will be same, but you're taking amounts and just interchanging them. That is all what happens when you prorate. But if you adjust entirely into COGS, it will directly impact your income. Okay. Yes. So to brief it up, if it is an under applied overhead, when actual is greater than applied, and it will be unfavorable. Any variance, if actual data is greater than the applied, actual cost is greater than applied cost, then it is unfavorable itself. Your COGS will be increasing. Then if it is over applied, actual expense is less than applied, it will be favorable for us because actual is less. Okay. Then it will reduce our cost of goods sold. Yes. Moving on. Next up, we have activity-based costing. Yes, I told you there are two systems for allocating overhead. One is traditional, other one is activity-based. So what happens in this activity-based? You will be identifying separate cost pools for each of the activities. Okay. Based on each level of activity, you will find out what is the root cause of this activity and what is its specific cost driver. Okay. As we are finding each and every cost and its root cause and its cost driver, ABC system is very effective in improving the efficiency of organization. You'll easily be able to find out what are the unwanted costs we are incurring and you can eliminate them. So ABC is very much essential in improving efficiency in our systems. Okay. But what happens with ABC is it is not accepted by US GAAP. That is why for external reporting, you can't use it. Only for internal reporting purposes, you can use ABC. So why is US GAAP not accepting ABC in spite of it having more efficiency? So the reason is ABC is considering some of the period costs. US GAAP strictly adheres to product cost definition and period cost definition. Okay. What ABC does is it will convert some period cost into product costs, which is not at all acceptable under US GAAP. That is why even though it is efficient, US GAAP doesn't accept it. For example, if it finds that salary of the factory supervisor is important, ABC. Okay. If it is a valid cost, that means if it is a very material cost, ABC will convert it into product cost category. But what happens if it is if US GAAP is considering that as a period cost, it should be treated as a period cost. ABC violates that. That is why it's not accepted. Okay. So now in activity-based costing, there are 3 steps that we need to take. First step is to identify the cost pools. You will identify what are the costs that I am incurring in the firm. So what is the unit level cost? What is the batch setup cost? What is the product levels cost? What is the facility cost? Everything we will identify. All the cost pools you will identify. Then what are the cost drivers behind them? For example, the setup cost, the cost driver for it will be machine setups, setup hours. Okay, this is how we identify the cost drivers. Then, after identifying the cost drivers, you will assign the costs into specific cost objects. That is what we do. Okay, now the comparison between activity-based costing and traditional costing. So when it comes to overhead allocation base, in traditional, you will just use DLH or MH. But in ABC, there will be multiple specific cost drivers. For each of the cost, you will have different cost driver and different allocation base. And when it comes to non-manufacturing costs, in traditional system, you will exclude it from the product cost. You will treat it as period cost. But ABC, it may include it as a product cost. That is why it is not accepted according to US GAAP. And that's why we will use it only for internal use. Both ABC, ABB not accepted under US GAAP. Okay. Then low volume products. For low volume products, traditional cost in the traditional allocation, you will undercost them. So same problem as we saw in the third method of joint cost allocation, physical volume method. Same thing here also. Then under ABC, accurately you will cost it, and whatever is the actual cost, you will allocate it. Then comes to accuracy, no question, ABC is more accurate than traditional. Then cost and complexity. Again, traditional is simple. You'll just allocate it based on DLH or MH. But in ABC, it's quite expensive and quite time consuming. Then unused capacity. Okay, guys, this is very important. So in the previous class, yesterday's class, we studied about this PV variance. There I told you an example. If your company has a capacity for producing 1000 units, and if you are producing only 600 units, 60% capacity utilization is there. 40% capacity you are not at all utilizing. Okay. So that problem is there in traditional costing also. It will assume that complete capacity we have used and all the cost it will allocate to products. The cost of unused capacity also it will allocate to products. So you know what happens if you allocate unwanted cost into products, it will simply overprice your products. If it overprices your products, you will lose customers. That is a trouble in traditional costing. Then what happens in ABC? It is not allocating unwanted costs into products. Just what is needed, we are allocating. That is ABC. Okay. Next up, absorption and variable costing. Okay. So again, absorption costing and the variable costing are two different costing methods of allocating the cost for your final products. We'll look at them, how distinct they are. So in absorption costing, what happens is, so in your product costs, you will be involving all your manufacturing costs, such as direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Properly, all product costs are treated as product costs in absorption costing. Okay. Now, when it comes to period costs, so all your non-operating costs, such as selling and administrative expenses, is treated as period cost in absorption costing. Okay. Now, what happens in variable costing? In variable costing, under the product costs, you will treat all your variable manufacturing costs as product costs. Okay. such as direct material, direct labor, and variable manufacturing overhead only is treated as product cost in variable costing. Okay, so look at this. The only difference in the product cost in absorption costing and product cost in variable costing is your fixed manufacturing overhead. Okay, fixed manufacturing overhead is treated as product cost in absorption costing, and it is treated as a period cost in variable costing. That is the only difference between them. You should focus on fixed manufacturing overhead. You should stick this, okay, into your memory, that fixed manufacturing overhead is the only difference. Then what happens? All your product costs, as usual, it will be added into inventory in your balance sheet. Now look at the values. So in absorption costing, your inventory value will be more because 4 costs are there in your inventory. When it comes to variable costing, only 3 costs you are adding. So your inventory will be less when compared to inventory in absorption costing. Okay. And now when it comes to income statement, in absorption costing, you will calculate it as sales minus variable manufacturing cost minus fixed manufacturing cost. It gives you gross profit. From gross profit, you will subtract your selling and administrative expenses, both variable and fixed. That gives us operating income. What is the structure we follow in variable costing? Sales minus variable manufacturing costs. It gives you manufacturing contribution margin minus variable selling and admin expenses gives you contribution margin. Contribution margin is nothing but sales minus all the variable costs. Then contribution margin minus fixed expenses gives you operating income. Okay. Now, US GAAP is accepting absorption costing, but not variable costing. Why it is so? Again, the same reason. Here, variable costing is treating one of our product cost as period cost, fixed MOH. That's why it's rejected. Then, the risk is in absorption costing, what happens, there is a possibility for managers to inflate your operating income by overproducing. When you overproduce the products, what happens? Your inventory will grow. I told you inventory and COGS always have opposite relation. If your ending inventory is more, COGS will be less itself, obviously. If your COGS is less, it will inflate your operating income. That's a trick managers can follow in absorption costing. Okay. And in variable costing, it is not accepted by US GAAP. But when you look at the perspective of organization, they find, and all the industry experts, when you inquire them, they feel variable costing is proper when compared to absorption costing. The reason is it is correctly classifying costs according to their nature. Variable costs are product manufacturing, variable costs are product costs, and all rest of the costs are period costs. According to cost classification, variable costing is proper. That is what they opinionate. Okay. Now, in exam perspective, what you need to remember is inventory value in absorption costing will always be greater or at least equal to the inventory value under variable costing. You know the reason? In your inventory values, you are considering 4 costs in absorption costing and only 3 costs in variable costing. That is why this distinction takes place. Okay. Now, what are the benefits of your variable costing? Your contribution margin, you can easily calculate. Then fixed manufacturing overhead is predictable. Here you're not dividing fixed manufacturing overhead among your produced units. Directly, completely you are expensing it. Okay, so when you are completely expensing it, that is how fixed costs are treated because they don't depend on your level of production or level of activity. Irrespective of whether you produce the goods or not, fixed manufacturing overhead will be there. So rightly, in variable costing, complete amount you will expense because it's unavoidable by us. Okay, then no manipulation of OI in variable costing. That's not possible. But in absorption costing, that's the biggest limitation. Okay, so advocates, as I told you, they feel variable costing is more towards the economic reality because fixed cost doesn't vary according to production. So according to them, variable costing is best. According to US GAAP, absorption costing is best. Okay, Guys, the thing that you should never forget is fixed MOH. That's the only difference between absorption costing and variable costing. And this one, inventory value in absorption costing will always be greater or equal to inventory value under variable costing. These two things always you should remember. Then, what are the differences that takes place in operating income? Okay, when it comes to the three cases, this thing you should fix it in your mind. So, before moving on to the calculations, one thing you guys be clear. Inventory cost in your absorption costing will have DM, DL, variable manufacturing overhead, fixed manufacturing overhead. Under variable costing, only DM, DL, VMOH. Okay. So by default, inventory value in absorption costing is more. Inventory value in variable costing is less. Now, we'll move into case 1. When production is exactly equal to sales, you are producing 100 units and selling 100 units. So, look at the cost of goods sold under absorption costing, 25,000. So, if your revenue is 50,000, operating income will be 25,000 again. And here also, variable costing, you will subtract 10,000 and fixed MOH 15,000 you will subtract again. You'll get operating income of 25,000. So, there is no change in operating income under both AC and VC when production equals sales. Okay. Now moving on to case 2. Observe this carefully. So if you're producing more units than your sales, producing 100 units, selling only 70 units, then in your inventory, there are 30 units that are remaining, isn't it? So what happens in absorption costing? In absorption costing, your cost of goods sold, assume it is 250 into 70. Okay. So your revenue will be 35,000. Operating income is 17,500. But what happens in variable costing? Cost of goods sold will be 70 into $100. Assume you are not involving variable manufacturing overhead. Okay. That is why it will be 100. So your COGS you are getting as 7,000. Variable manufacturing overhead, completely you will expense it. 150 per unit, 100 units produced. Completely you will expense. But here you will prorate it. Only for 70 units you are considering. 30 units will postpone to next period. So look at this. Operating income became less. So operating income under variable costing became less than absorption costing when production is greater than sales. Then this third scenario, when sales is greater than production. When does this happen? When you have beginning inventory already in place. So when your sales is greater than production, what happens? You're drawing from old inventory. Under absorption costing, it will be 37,500. If your revenue is 75,000, operating income will be 37,500. But in variable costing, what happens is, you will consume this 150, you'll consume this cost of goods sold of 100 into 150 units. Okay, 100 into 150 units will be your 15,000. 100 into 150. You will be getting it as 15,000. Okay. Then what happens to your revenue? Again 75,000. 75,000 minus 50,000. You will be getting it as 60,000 operating income. Operating income will be more here because fixed manufacturing overhead completely you have expensed in the prior year itself. Now you need not carry it forwards. Okay. So that is what happens in variable costing. So variable costing, it will have more operating income when sales are greater than production. To sum up, what you have to remember, when production equals sales, no difference in operating income. When production is greater than sales, operating income in AC will be greater than VC. When sales is greater than production, operating income under AC will be lesser than VC. That is all you have to remember. And what is the difference in between this income calculation? It is your fixed manufacturing overhead. That is the only difference. Okay. Yes. Is everybody clear with traditional costing and ABC and how to allocate them? Any doubts? Okay. So next up, we are moving into shared service cost allocation. So what is this concept of shared services in the sense? In an organization, there can be service departments and the production departments. So these service departments, they will be serving themselves and also the production departments of the organization. Now, according to the services given by service departments to the production departments, we have to allocate the costs of service departments into the production departments or main departments. Okay. So how do we allocate it? That is what we study in shared services. Okay. So there are three methods: direct method, step down method, and the reciprocal method. So direct method is very simple and it's most common. So here what happens in direct method? Service departments, they can serve each other. Assume that there are two service departments and three production departments. Service departments, they will definitely serve the production departments. Okay. So all the three production departments they are serving and they can serve each other also. That is, two service departments can serve each other. In direct method, what happens is we ignore that service departments are sharing the services among themselves also. We ignore that. Completely, whatever cost of service department is there, you will be allocating it completely into production departments. That is what happens in direct method. Okay. Ignores cost allocation between service departments. No inter-service allocation. All service department costs are allocated directly into the production department. Okay. And we will look into the calculations later. So here, it is fast but least accurate. Why it is least accurate? Service departments are serving themselves as well, but we are ignoring that. Okay. Then next up, we have the step down method. Here, again, we'll take an example of two service departments and three production departments. Here, one assumption is we assume one of the service department is serving the other. We'll consider that. So they might be serving each other, but only one service department is serving the other. This is what we consider. And they are serving for the rest of the production departments. So again, here, one service department's service to the other service department, one way you are considering, okay, and not the other service department's service that the first service department took. Only one's consideration is allowed. So that is what happens in step down. Partial recognition of inter-service department services. It allocates in a sequence chosen by management. So here you should choose, right? Which service department cost to allocate to the other? You should choose. Only one service cost allocation among the service departments is allowed. For that you should choose. How do you choose? It will be based on management's decision. They will choose which service department cost you can allocate for the other service department. Then once a service department's costs are allocated out, it receives no further allocation back. When you look into the numerical example, you will understand better. Don't worry. Okay. Here, most accurate than the direct method, but it is less complex and it is less complex than reciprocal method. Okay. And it is one directional. Once you allocate a service department cost to other service department, in reciprocation, you can't receive back from it. And third up, we have the reciprocal method. It's the most accurate and the most complex one. Okay. Because it recognizes all service provided between shared service departments. That means all sorts of services that you have given for other departments and taken from other departments. Everything will be accounted for in reciprocal method. Okay. So here it uses simultaneous equations for the calculation. And theoretically it's correct because all cross allocations are properly captured and rarely used in practice due to mathematical complexity. When it comes to practical use, it becomes very time consuming and complex for using reciprocal method. Only when it is possible, we will be using it. Else, we will be choosing either direct or step down method. Okay. Now we'll look into the calculations. So this is the calculation of direct method. So what do we tell? Service departments, this cost will be allocated among the production departments. And we are not, even though maintenance and cafeteria are service departments. and production 1, 2, 3 are production departments, main departments. Here, maintenance department will serve cafeteria and all the 3 production departments. And this department, maintenance, it will take service from cafeteria also. Both the things are there, giving service, taking service. But in direct method, what happens? You will allocate the service department costs into production departments. Based on what? Based on the percentage of service they have taken. 20% of service in the sense 100 into 20%, like that. Based on percentages, you will be allocating. And again, in cafeteria's cost, you will allocate it based on percentage of service that they have taken. This is how we allocate in direct method. Okay. If you can notice, even though maintenance and cafeteria serve each other, you are not considering that in direct method. Now what happens in step down method? Here, what we told, one service department cost we can allocate for the other, and others, the service department that is consuming the cost of the first service department, we can't reciprocate and allocate its cost back to maintenance. Now, which department cost you are going to allocate, that will be decided by management. Here, management has decided that maintenance can allocate its cost for cafeteria, but cafeteria cannot allocate it back to maintenance. That is the rule of step down method. Okay. Now, maintenance will allocate 100 into 10, 16, 28 and 46. But cafeteria, now its cost got increased to 130. Again, it can't allocate back to maintenance. Not possible. It will allocate it into 3 production departments. So which service department will allocate it? So this will be chosen by management, and in your exam question, they will mention allocate maintenance into cafeteria. They will mention. Okay. Next up, we have the reciprocal method. In reciprocal method, what is happening? Complete capture of services we will be doing here. Maintenance is giving service to cafeteria and it is also taking service from cafeteria. Even cafeteria, it's giving service to maintenance and taking it from maintenance. Here, you will include all of the costs that are present. Now, how do you frame the simultaneous equations? So, you will have to frame the simultaneous equations. Before we discuss, can anybody tell me the simultaneous equation that you're going to frame for maintenance department? For percentage that you need to share, right? You can take it as 20%. Rest of the equation, you guys frame it. What will be the equation for maintenance department? Okay, so it's very simple. So in this equation, you have to locate what is the total cost that each of the departments are incurring. So the purpose of this equation is to find out total cost. Okay, so total cost for maintenance department will be 100. That is its own departmental cost plus, I told you to consider 20%. 20% of cafeteria cost. Okay. Again, in cafeteria department equation also, we don't know what is the total cost of cafeteria. How do you consider? 120 is the cafeteria department cost plus, again we'll choose 30% here, an assumption, 30% of maintenance department cost. Okay. These are the two equations that we frame. We have two unknowns in these equations. Now, how do you proceed? You will substitute one equation into the other. Okay. So, we'll just look at it. Maintenance department equation will be 100 plus 0.2 multiplied with what is cafeteria's cost? You should consider this entire equation. Okay. Maintenance department cost, you can just consider this as 0.3 MD. Okay, this is how you frame, MDE you can take. This is how you frame an equation, and now you can easily solve this out. First, you will get maintenance department equation, total cost. Then again, substitute that here in the second equation. You'll be getting it for cafeteria. Okay, all of you are clear with reciprocal method? Framing simultaneous equations is very much important, guys. You should practice it very well. Clear? Okay, guys, what about the rest of the students? Navya is clear. What about remaining students? Any doubts? Okay. You guys have to practice as many MCQs as possible. Okay. Yes. So next up, we have a simple concept, which is about estimating our fixed cost or the variable cost. Okay. So when do we use this method? Suppose you have got the data. Okay. But they have not mentioned what is the extent of fixed cost and what is the extent of variable cost for you. They have not mentioned. At that point of time, you yourself have to find out what is the fixed cost and what is the variable cost. At that point of time, what you will do? So you can use both of these methods for calculation. First, let us look into high-low points method. So let us assume they have given you the data for 10 months. 10 months data you have. What is the data they give? They have given you sales and units sold. These two data they have given you. For 10 months, you have the data for units sold and sales value. At that point of time, how do you calculate? First up, you will have to calculate the variable cost per unit. How to calculate? Among the 10 months of data that is being given to you, find out which is the highest cost or highest value that is being given. Minus, find out which is the lowest cost among the data given. Okay. Then you will be dividing it with the units that whatever they have given, the units with respect to highest level and units with respect to lowest level. This is the equation. If you solve this, you will be getting variable cost per unit. Then the second step, you can easily find out the fixed cost. How to find out fixed cost? Either you take the cost at highest level or cost at lowest level. That is inclusive of both fixed and variable cost, isn't it? So, fixed cost will be equal to total cost at high. Here they have taken high minus variable cost per unit into high level activity, whatever units you have at the highest cost. Okay, then you will be getting your fixed cost. This is how you estimate. Okay, so here high-low points method is very simple. It's simple but uses only two data points, may not represent full data. This is the equation we use for calculation, which is using only two data points. They say that it may not represent full data. 10 months data we are not able to represent. But it will be very best for your quick estimates. Okay. And then comes regression analysis. Regression analysis, all of us have practiced already. So it is y equals to a plus bx. Y is dependent variable, x is independent variable, a is fixed cost, b is variable cost. So you know how to calculate using this equation. They will give you all the values. What you have to know is what each value of the equation stands for. you should know. Then it will be easy for you to calculate. Okay. And then it uses all the data points and it is run on the computer. Usually regression analysis and all, using computers only you can't do it, because here it's not, in companies it will not be very easy because they will have vast amounts of data. So they use computers and statistics software on computers to run regression analysis. And it is more accurate when compared to high-low method. And here R square, which is the coefficient of determination. No need to know what is R square, how to calculate and all. Just know that if your value, whatever you are finding, R square, if it is closer to 1, that is a better model of statistics to use. Just a add-on information. Okay. So then next up we have about the life cycle costing. Okay, guys. So life cycle costing, it's very easy for calculation. Okay. So how do you calculate life cycle costing? In the sense, all the cost that is incurred for that product, starting from designing the product till you exit that product from the market. All the costs starting from pre-production till post-production and exit from the market, everything you will consider it as a product cost. Okay. And all the cost you will subtract from sales revenue estimated, then you will be getting the product, the profit. So where do you use this life cycle costing? Suppose I want to start my own brand of clothes. Okay, my own product line for fashionable clothes. Now what do? I run this life cycle costing. What will be my pre-production cost, research and development and design? What will be manufacturing cost? What will be post-production cost? Every cost I will add up together. Then I have the estimated sales revenue that I can collect from the customers. Okay, so I will subtract that all these costs from sales revenue for which I have estimated. Okay, life cycle costing, guys. One thing you should remember: if I'm planning for my product line, I should plan it from the beginning, inception, till what year I want to continue this product line. Let's say I want to continue this for 10 years. 10 years completely I will have to plan in life cycle costing. So 10 years cost together you should pile up. 10 years sales revenue together you should pile up. Then you should find out profits. That is life cycle cost. Okay. Then again, in the customer's perspective, you will have to calculate this product cost. What is the product life cycle for the customers? Okay. So customers will be paying us a price that is greater than the cost which we have incurred. Okay. Now when it comes to the price they are paying for the product, they want to know the utility. Okay. So this utility, it has to be greater than the cost that they are paying for the product. So that is product life cycle cost. As an average customer, how much you will spend throughout the life of that product. Suppose you are purchasing a laptop. Until you sell that laptop for a scrap person, what is the total cost you are paying for that laptop? And is it worth the money you are paying them? So that is product life cycle cost. Okay. Okay, guys. Next up, we have it for operations management. So in operations management, we will be looking into supply chain, the lean concepts, JIT, MRP, and ERP. Okay. Let's have a quick glance at all of them. So what is the supply chain in the first place? Supply chain means it starts from the place where we procure the raw materials and it ends when we sell the final products to the customer. Starting from raw material procurement till we sell the final goods to products, supply chain is there. Okay. So it is entire network of people, organizations, activities, resources, technologies involved in producing and delivering to final customer. Now, why is it important for us to manage our supply chain? Because supply chain, when you look at it carefully, it is involving all your costs which you are consuming for a product. Okay. So now what you have to focus on, you should focus on eliminating non-value adding costs. Okay. And focus on improvising the efficiency. Okay. Now, the key activities that we need to observe in a supply chain is purchase, production, inventory management, transportation, distribution, and customer service. These are the key activities. Okay. So, what do we try to maximize in SCM, supply chain management? It is to maximize our customer value and achieve sustainable competitive advantage. So, in the section B, we discussed how important it is for achieving sustainable competitive advantage, always to remain at the top. Okay. And now, some of the key activities which we do in the supply chain management is outsourcing, which we already know. And why? What is the purpose of this outsourcing? Because if you find out a country that gives you quality labor for a less cost, obviously you will outsource your functions to them. That is, in a proper word, we call it as offshoring. Okay. Next up, we have this lean resource management. This is a very good concept that was brought from Toyota organization. So what they did is their major aim was, so when you produce a product, for what costs will the customers be willing to pay? It is for value adding costs. If you are adding any new feature to the product, any new quality to the product, anything new you are adding to the product for which customer is willing to pay, that is your value adding cost. Okay. So what Toyota did was, we will incur only value adding cost. Why to incur these non-value adding cost? So we will prepare our production process in such a way that we are incurring only value adding costs, which customers will pay for us. We will eliminate, if it is possible, we'll eliminate our non-value adding costs, or at least we will reduce them. So this is what they planned. Okay. Now, what they were focusing on is to eliminate the waste. So if you are wasting any products, or if you are producing products wrong for the first time, again, that is a wastage. All these wastages we want to remove. Okay. And they thought that there should not be any idle time in the production process. If a product is starting as a raw material, until it reaches its final customer, it should not stop anywhere. In a quick pace, it should move through the production process and reach its final customer without any delay. That is called as throughput. Okay. Once you start your production process, no gap should be there. As quickly as possible, it should complete with the production process and reach the final customer. That is called as the maximum speed or maximum throughput that we can achieve. Okay. So they planned for eliminating wastage so that they can increase the throughput. Okay. And lean accounting is costing for the value stream. Whatever value adding cost is there, you'll not segregate between product cost or period cost. If it's a value adding cost, it is a product cost for you, according to lean resource management. Guys, one thing you should focus on is this ABC, life cycle costing, lean resource management, all of them, they treat cost according to the benefits they are getting. Okay. That is why they don't comply with US GAAP. And we are not supposed to use them for US GAAP. Okay. Wherever you see this costing by value stream according to their own methodologies, it's not accepted by US GAAP. Then it is beyond manufacturing. So not only in manufacturing sectors, this lean resource management was such an excellent concept. It was implemented in healthcare, warehousing, and service organizations as well, and in many more industries. And there are 5 main principles with which lean resource management follows. And it's very simple also. First, you will identify what are the value adding features according to the customers. You will identify that. Okay. Then what you do? You will create a value stream. You will prepare the process where you include only value adding activities. That is creating value stream. Then flow. If a product starts in its first step, until it reaches the customer, it shouldn't stop anywhere. That's the continuous flow. Then pull. Pull strategy means there are two kinds of strategies, guys. Push strategy and pull strategy. Pull strategy means your customers want you to produce products and sell it to them. Okay. Push strategy means you have a lot of inventory in your company. You just wanted to push it for your customers. You'll give them lot of discounts and lot of offers, and you will just sell it to them. That is push strategy is what happens during festive seasons, Diwali sales, and all of those things. They are push system. Pull system is we demand the products and get it done from the company. That is pull system. Then comes perfection. When you're producing a product, make sure producing it right for the first time. That's perfection. This is what happens in lean manufacturing. Okay. Next up, just-in-time systems. Again, just-in-time system is a pull system. So again, this was an initiative by Toyota itself. So what they did was, they thought that maintaining inventory in an organization is very costly. It has more costs. So what they did, today if they want some raw materials, today itself they'll order, they'll get it, they'll use it in production process and finish it off. They don't store any inventories. So they'll be able to save many inventory related costs. Okay. So it's a demand pull system. Whenever your customers are ordering, you will place an order for raw material, finish the production process and give it to them. Okay. So based on customers' orders, you will be manufacturing. That is a pull system. And one more thing which you have to remember in JIT is you need an excellent supplier relationship, because your supplier should be in such a way that if you order the raw materials, immediately they will have to deliver, or else your delivery of cars or final product to your customers will delay and you will lose customers. So it's a very aggressive system. That means you're taking more risk in JIT. Okay. For that, you need a backup. What is that backup? Very good supplier relationships. If you order raw material, immediately you should get. That is the relationship we should have with our suppliers. Then here the goal is to reduce our inventory related costs. Okay. And here we will be focusing on reducing batch setup time. Smaller batches will be economical for us, and we will also lower the lead times. Okay. And the benefits of JIT are lowering the inventory costs. You will be incurring fewer defects, because now there is a need to produce your products right for the first time, or else you'll lose customers. So that's a risk that they take. So there will be fewer defects addressed which should be addressed quickly. Okay. And less floor space. Then comes limits. Requires close workstation coordination. So the thing is, you should produce goods very quickly and submit it, give it to your customers. Okay. So very good workstation coordination is a necessity. Then comes lean concepts. So lean concepts, Kaizen, we know this. It's a continuous improvement. And Kanban, it's a signal. Okay. I'll give you one example for Kanban. So it's a signal that more work needs to be done, or more inventory units are needed, or more raw material units are needed. Okay. So how do you show the signal? In the sense, there is a production department, assume. Okay. And Kanban is nothing but the bins in which you will fill the raw materials and send it to production departments. You will have assigned that for production process, 10 Kanbans or 10 bins of raw material is sufficient, and you will send it to production department. Okay. Then production department will use all your raw materials and produce the products. If they find that they still need some more raw material, they will send Kanbans to you, stating that they need 2 more Kanbans of raw material. So what did we notice here? Production department is overusing raw materials. They're giving a signal that they need more work to be done. They need more raw materials for completing. That is what we track here. Okay. That's a simple example of Kanban. Then comes continuous flow. We know this. Work cells. Okay. So guys, work cells, how do you need to position them is either U-shaped or horseshoe shaped. The reason is here, work needs to be done very quickly. Throughput time, throughput needs to be maximized. It should be increased. For that, what is the requirement? Work cells should be very closely coordinated, very closely placed. So U-shape and horseshoe shape, as per the industry practices, they have proved to increase the efficiency of workstations. That is why work cells should be in those shapes. Then error proofing, POCA-OK assessment. That means when you're producing your products, it should be produced right for the first time, or else simply wastage of resources, right? So they will have to position in that way that products are made rightly for the first time. Then JIT is a pull system, MRP is a push system. This is a key distinction you should know. Now, what is this MRP? Okay, MRP, MRP2 and ERP are other concepts now. MRP is material requirements planning. Material requirements planning means you need raw materials. You need to place order for your raw materials. Okay. So materials requirement planning, you will be focusing on demand. Okay. Computer-based inventory and scheduling will be used for dependent demand inventories. It's a push-through system. That means you will not wait for your production departments to ask you to purchase for raw materials. That will increase production time. What we will have to do, we will have to purchase inventory well in advance and place it. And we will push it to our production department. Okay. So MRP works on a push-through system. Then MRP2 is a slightly wider concept. It is manufacturing resource planning. Here, all the activities related to production you will take care. In MRP, only raw materials. In MRP2, design engineering, scheduling, inventory management, cost control, everything related to production we will be taking care. Okay. Then comes ERP. ERP is all binding. Okay. ERP is a system which helps you manage all the departments of your organization from a single person. We call it as dashboard creation. Okay. So you will have your tone at the top who will manage everything from every department they'll manage. There is a centralization of data. Okay. So here ERP is such a system that we know that sales department, production, purchase department, everybody is interrelated to each other. Okay. If sales department is updating their ERP, whatever access they have, quickly sales units will be visible to production department. Next, production department will update theirs. How many units they need to produce. Quickly it will be available for inventory department. What inventory they should purchase and keep it ready. So very quickly it will happen. Okay. But the only disadvantage of this ERP is it's not customizable as of now. There are only few systems of ERP that is available. You should choose which suits your organization. But it's very useful if it works well for an organization. Next up, it's about our value chain. Okay, so value chain, as we all know, it starts from the way where we purchase our raw materials and ends only when we give our services to customers. So it describes a business unit's chain of activities, transforming inputs into outputs that customers value. And this was introduced by Michael Porter in the year 1985. So in this value chain, again, the name itself says only value adding activities we will be focusing on. Okay. So value adding activities, you will be considering them as primary activities. Okay. And guys, this concept, you should know it exactly. You should memorize it. Okay. You'll be starting from inbound logistics. That means when you order the raw materials, what are the transportation requirements to receive raw materials in your firm? That's inbound logistics. Followed by inbound logistics is your operations. So how do you transform inputs into outputs? That's operations. Then comes outbound logistics. How do you transport the finished goods to your end customer? That's outbound logistics. Then marketing and sales. Customers should know what are the products available, what are its features, what are its uses. For that, marketing and sales is very much important. Then comes customer service, ultimate requirement for satisfying our customers. Warranties, refunds, and customer service. Customer service in the sense, you will have to repair the products for them or replace the products for them, respond to them properly. That will be customer service. Then comes support activities. These are not so value-adding activities. Value-adding activities means for which customers are willing to pay for. So these are some of the activities for which customers are not convinced to pay for. Okay. non-value adding activities. So support activities will be infrastructure. So what are the departments that we have to support our functioning? That's infrastructure. Then HR management, recruiting, hiring, training, compensation. Then technology development, improving the products, processes, and service throughout. As in how technology improvises, we have to improve our products as well to remain in flow with dynamic environment. Then comes procurement. So how do we purchase the inputs? How do we use them? That is procurement. And all these four are support activities. Okay. So next up, we have the last concept of section D, which is quality management and benchmarking. Okay. So we'll look into what is this quality management. Okay, guys. So let me tell you the introduction to this concept so that we'll understand this better. Maintaining the quality of products is very important for the company. You know why? Because it is directly influenced to your customers. If your customers are satisfied, only then company will run, company will be surviving, and it will be profitable. They lose the customers, that's the end of any given business. Any given business, the biggest loss they will be afraid of is losing the customers. Okay. And look in the eyes of the customers, we will not purchase the products which have low quality, which will be defective. Okay. That is why they will give maximum importance for maintaining quality of the products. And to maintain the quality of the products, there are two sets of costs that we incur: cost of conformance and cost of non-conformance. So what are these costs of conformance and non-conformance? Cost of conformance means, as a company, I know that my customer needs very good quality products. So in the first place, I will be in an attempt to produce quality products. I'll take all these steps necessary so that the quality of the product is best. Okay. So what are the costs I will take? Those are known as conformance cost. In conformance cost, we have prevention cost and appraisal cost. So what are these prevention costs? In the sense, taking measures so that errors do not take place. Okay. These are the first step that we take. So we will, what are the steps we can take to avoid the errors in the first place? You will design your production process properly. That is called as design engineering, process engineering. That should be proper first. Quality training programs should be given to your employees as well as supervisors. And preventive maintenance of equipments whenever necessary. Then supplier selection, raw material quality should be good. If you expect ending product to be good, raw material quality should be good. So supplier selection and evaluation is required. Testing and evaluation of materials. When you get raw materials from supplier, immediately you will not force it into production departments. You will have to test what is the quality of raw materials. Then we have to send. Then comes quality improvement programs, which is called as Six Sigma. So what Six Sigma says is 3.4 defects allowed for million opportunities. That means 34 defects, 34 products out of if we sell 10,000 products, among them 34 can be defective. That's a normal range. So that is 3.4 products can be defective per million opportunities. That is what Six Sigma says. So what is this specification? That means, as I told you, loss you can't prevent it 100%. You can't say all the products that you produced are 100% quality perfect. So there will be some sort of errors. So that is the Six Sigma says is the acceptable level of errors, which is 3.4 defects allowed per million opportunities. Okay. Then appraisal cost. Okay. So here, after taking prevention cost, so what happens is in appraisal cost, you will be taking measures again by testing and inspecting the equipment. So here, appraisal cost also, before sending your goods to the final customers, before selling it, you will be testing it, whether quality is right or not. Okay. And appraisal cost, how do you find out? It will contain keywords like testing, inspecting. All these words will be in appraisal cost, especially the word inspecting. Okay. testing and inspecting equipment, equipment for testing or inspection, quality audits, and monitoring production process before delivery to the customer. Before you deliver products to the customer, the steps you take will be in appraisal costs. Then comes our non-conformance cost. After taking all these measures also, some defects will be there. So that leads to internal failure and external failure. Internal failure, it is detected before you, okay, I'll tell you. Internal failure is after production process is completed, before you deliver products to customers. That is when you identify internal failures. External failure is you have sold the products to customer and customer has identified the defect. That is external failure. What happens in internal failure? Spoilage, scrap, rework, re-inspection costs, then tooling changes and machine downtime, lost contribution margin. Why lost contribution margin? You have already produced the product and after that you are realizing that it has defects. So again you should correct that product, right? That will require a lot of time. That is lost contribution margin. And engineering costs to redesign. So internal failure cost, it will contain words like rework, re-inspect, redesign. From that, you will have to find out. Then comes external failure, non-conformance cost again, customer service and complaint handling. The worst cost that you can get among the four is external failure cost. You will lose your customer there. Okay. Customer service, complaint handling, warranty repair or replacement costs, the product recall or liability costs, all of them after selling, if you find out any failures, that is external failure. Okay. So prevention avoids the defects. Then appraisal will detect before shipping. Internal failures will be caught before customer notices it. External failure will be caught by your customer. Okay. External will be most costly. Next up, now we came to know how important it is to hold good quality of the materials in the organization. Now we need some measures so that quality is maintained, right? So that is why total quality management was introduced. So this will help us find out what are all important steps that we can take so that we will prevent the errors from taking place. So that we'll take very good management when it comes to quality of products. So here, the aim of TQM is being committed to customer satisfaction plus continuous improvement. These two are the ultimate aims. What are the objectives? Consistent quality maintenance, timely customer response, elimination of non-value adding work, and quick adaptation to new technology. These objectives are important. So when it comes to TQM, you should exactly know what it means. Okay, memorize it. Then the core principles are top management support and active involvement of everyone in the firm. Then clear and measurable objectives are important. Recognize the quality achievements timely. Before time, you should recognize it. After selling goods to customers, there is no use recognizing quality defects. Then continuous training in TQM. Everybody needs to be trained to maintain good quality. Kaizen, continuous improvement. And customer focused, and it involves all the employees. Okay. Then comes ISO 9000 and benchmarking. So what is this ISO 9000? International Quality Assurance Standards. Okay. So it is not for individual product quality and it ensures consistency of quality across production. So I'll explain the meaning to you. Okay. Suppose we'll take an example of ITC. Okay. So ITC is giving us various products, consumable goods. So in this various food products, what does ISO 9000 mean is not ensuring that individual product quality. So let us take the example of the biscuits that are produced from ITC. Okay. Not ensuring that each packet of biscuit has the product quality, not that. So when they are manufacturing the biscuits, right, they should not compromise with the raw materials used, the standard of labor used, okay, and the manufacturing production process that they are taking place. That shouldn't be compromised. So on the day one, what was the method, what was the quality of raw material they were using? The same consistency they have to continue. With the same consistency, quality should be there in the production process. That is what ISO 9000 means. When they are producing the product, whatever consistency they had before, same thing should be carried forward. They should not compromise that. Then it is introduced by International Organization for Standardization. Yes. Then comes benchmarking. Benchmarking we know already. It's holding our the best performance in our industry as a benchmark, as a comparative index. And we will focus on reaching there. That's benchmarking. Okay. Here we need to identify the critical success factors. We should involve the best practices through the distinctive competencies. Then we should establish performance standards, identify the improvement areas, the increased efficiency, customer focus, and manage change. That means all what it takes to remain at the top, we will have to do all those activities. Okay. Then comes the statistical quality control tools. There are some statistical tools that we use for maintaining the statistical quality control. Okay. So let us look into them. The control chart. So this control chart, it records observations at regular intervals, shows if process is within acceptable range. That means the quality of the product should be in the acceptable range. If it is not within the acceptable range, you will have to inspect it. Through the control chart, you will come to know, is the quality under acceptable level or not? And you will take measures for that. Histogram, we all know. It's a bar graph showing frequency of events, visualizes distribution of defects and variations in a data set. You will record. Okay, suppose I'll tell you an example. You are producing a product and you have found out 4 quality defects in it. 4 reasons for quality defects. And you will plot the frequency in which these defects have taken place. Okay, and the highest bar or the highest line that you plot in the histogram, that will show you what was the highest factor that caused you the maximum loss. That is how we use histogram. Then Pareto diagram. Okay. So this follows the 80-20 rule, which we came across in the previous session. 80% of your problems will be caused by 20% of the causes. 20% of the causes leads to 80% of defects. So what are these 20% of the causes? We will identify them, solve them first, move on to the next cause next. That is what we do in Pareto diagram. Okay. Then Ishikawa diagram or fishbone diagram. So here, this diagram, it got the name fishbone diagram because it just looks like the fish bones, fin bones. Okay. Now what happens is spine, the longest bone. Okay. That gives us the quality quality problem. What is the problem that we face? The main problem will be depicted in spine. Then across these spines, there will be ribs. Okay. Small bones. That will give us the sub-causes which cause the main cause. Okay. And this diagram will be self-explanatory. Whosoever reads it will easily understand. Okay. So now we've walked through all the important topics in section D. Okay, guys. All of you are clear with all the topics we discussed? Any doubts? Yeah. What about the remaining students? Any doubts?